Hi, my name's Libby Newman and I'm an investment strategist here at Vanguard. Welcome to this month's investment and economic update. There has been a flurry of news out of the US. Fun fact, as at the time of recording, there's been 93 executive orders issued by President Trump in 2025, compared to 47 in his first term in 2017. The markets have been unsettled by the moves and counter-moves, particularly around immigration and tariffs, and these announcements have implications for growth, softer, and inflation, higher. The real-time signals our economics team monitors point to a material slowdown in growth in 2025, such that our full-year US GDP forecast has been lowered from 2.1% to 1.7%. GDP was 2.5% in 2024 and 3.2% in 2023. The effects of US tariffs and other nations' countermeasures on those are putting upward pressures on goods prices, leading us to increase our inflation forecast from 2.5% to around 2.7%. Inflation, therefore, is still running above the US Federal Reserve's 2% target. Speaking of which, the Fed left policy rates unchanged at its March meeting, but acknowledged that the role of tariffs was a source of uncertainty. The Fed chair suggested that higher inflation related to tariffs would likely be transitory, as was the case amid the institution of tariffs in 2018 and 19, and thus less likely to require interest rates, but it's still a delicate balancing act for the Fed. We believe that the bar for the rate hikes is probably going to be higher than for cuts, and so we continue to expect 50 basis points of cuts throughout 2025, which is pretty much in line with the Fed's own expectations. The Australian economy avoided a recession, registering GDP growth of 1.3% for the full 2024 year, despite an aggressive monetary tightening phase from the RBA. An easing cycle has now begun, with the first rate cut delivered on February 18, bringing rates down to 4.1%, but we expect the pace of cuts to be gradual. The RBA has noted that the labour market continues to be tight, so we expect caution in further rate cuts. We do see the cash rate, however, ending the year in the region of 3.5%. Equity markets have given back some of the early gains of Trump's presidency, especially in Australia, interestingly, but it's important not to let these episodes of volatility, which are largely driven by a noisy daily news cycle, derail your longer-term goals. You can't really control how the market reacts or responds to these announcements, so stay focused on things which are in your control and actually make a bigger difference to your investment success in the long term, like how much you are saving and the fees that you pay. Top tip, keep the first one high and the second one low. Keep more of what you earn over the long term. So click on the link to read on.